Picture this. You check your screen, silver is ripping higher, the internet is screaming new breakout, and then, in what feels like the time it takes to make coffee, the move flips on its head. People who saw one price at the top swear it printed around 117, and just a few hours later, the same feeds were flashing near 102. That is not a normal day. That is the kind of move that makes traders feel sick, makes long-term holders question everything, and makes everyone ask the same thing. What just happened? And who pushed the first domino? Now let me ask you something. When a market moves that fast, do you really think it's only buyers and sellers calmly changing their mind? Or is it usually something sharper? Like a headline, a policy leak, a tariff threat, a margin call, or a big player needing cash right now? Because today's story is not just silver went down. The story is how one political shock can hit global trade expectations, how that hits Asia first while most of the US is still sleeping, and how a liquidity scramble can spread into places you wouldn't expect. And yes, we're going to talk about the Trump factor, the tariff angle, and why South Korea suddenly became the center of a sell button chain reaction. Before we jump into the timeline, do me a quick favor. If you like fast, clear breakdowns of market chaos like this, no fluff, just the story and the mechanics, hit like and subscribe. It helps the channel a lot, and it tells YouTube you want more updates when these blink and you miss it moves happen. All right, here's the first key thing you need to understand. When people say silver went from 117 to 102, that number might not be the clean, official spot silver price you see on finance websites. In wild moments, different platforms show different things. Futures versus spot, after hours versus regular session, different contract months, different liquidity, even temporary pricing spikes on thin order books. Sometimes you don't see a print that looks insane because liquidity disappeared for a moment and an order punched through what was left. The bigger point isn't the exact pixel on the chart. The bigger point is the speed, the direction change, and what that reveals about stress in the system. So what kicked it off? The first spark, as usual, was words, specifically tariff words. When Trump is in the headlines, especially with anything that sounds like new tariffs, bigger tariffs, or targeted tariffs, markets don't wait for paperwork. They price the threat. Algorithms scan it, traders front run it, and big money starts doing the one thing it always does when uncertainty jumps. It reduces exposure and raises cash. Here's where silver gets tricky. People love to talk about silver like it's just a safe haven, like it only goes up when fear goes up. But silver is not pure fear. Silver is half safe haven story, half industrial demand story, and the industrial side matters a lot when the fear is about trade and manufacturing. If the market starts thinking, global trade might slow, electronics demand might soften, factories might pull back, silver can get hit from that angle. And when it gets hit while leverage is high, it doesn't fall gently. It drops like someone pulled a chair out. Now add the second layer, positioning. Silver is one of those markets where a lot of players use leverage. Retail traders use leveraged products. Funds use futures. Miners hedge. Some players use silver as part of a broader inflation trade. And when a fast move goes against a crowded trade, you get forced selling. Not I changed my mind selling, forced selling. Stop losses, liquidations, margin calls, risk desks, calling traders and saying, cut it, now. So the timeline starts with a jolt of tariff chatter. The market starts repricing growth and trade risk, and silver, caught in the middle of safe haven and industrial, starts whipping around. But that alone usually doesn't create a 4-hour cliff. The cliff comes when liquidity thins out and one big seller hits a market that is already off balance. Think about it like this. If a room is full of buyers and sellers, you can move size without moving price too much. But if half the buyers step back because they're scared and then a big seller suddenly needs to dump, price doesn't search slowly. It gaps. It drops to the next level where real buyers are willing to stand. And this is where the South Korea angle enters the story. While US retail is focused on Trump headlines, the real-time stress tends to show up first in Asia because of the clock. If a big institution or corporate treasury in that region needs dollars, needs to post collateral, or needs to unwind risk before the next session opens, they don't wait. They sell what they can sell. And what can you sell quickly when you need cash right now? Liquid stuff, highly liquid assets, things you can dump in size without asking permission. That can mean equities, it can mean bonds, it can mean FX hedges, and yes, it can mean commodity positions that were never bets in the first place, but were tied to hedging, collateral, or structured products. So as silver started slipping, it triggered more selling, and then more selling triggered the kind of move where people swear the chart teleported. That's the feeling you get when the market is not trading on opinion anymore. It's trading on survival. Now ask yourself, if someone big was forced to sell, who would be big enough to matter and under enough pressure to move quickly? That takes us to Samsung, and why the phrase emergency liquidation started floating around. But before we go there, let's lock in one more important idea because it explains why this type of crash feels so unfair. In fast markets, price doesn't move because everyone agrees. Price moves because the best bids disappear. The moment bids vanish, the next trade happens lower by default, then lower again. That's why you'll see a cascade where the chart looks like a waterfall. It's not everyone selling at the same time. It's nobody willing to buy at the old price, and one seller willing to accept whatever is left. So if you were watching silver and thinking, how can it drop this hard when inflation is still a thing and the dollar is still doing dollar things? The answer is, in the short run, liquidity beats logic. Here's the part most people miss. Tariffs don't just raise prices at the store. Tariffs attack planning. They attack the confidence that businesses need to commit to big orders, big builds, and big hiring. And when the target is tech, chips, phones, components, South Korea is in the splash zone, whether it's the direct target or not. Samsung is not just a phone company. It's a supply chain galaxy. It touches memory chips, displays, batteries, appliances, and a massive web of suppliers and customers. And in tech, margins can be thin, cycles can flip fast, and inventory can become a nightmare if demand slows at the wrong moment. So when markets start hearing tariffs and trade restrictions, they don't only think about the consumer paying more, they think about the entire pipeline backing up. They think about unsold inventory. They think about capex being delayed. They think about currency stress. And they think about companies needing liquidity to ride out turbulence. Now, let's be very clear with wording here, because the internet loves to run with dramatic phrases. When people say Samsung emergency liquidation, that doesn't automatically mean the company is broke or collapsing. Giant corporations liquidate in the most boring way possible all the time. They sell liquid assets, unwind hedges, rotate cash, raise dollars, reduce risk. It can be defensive, it can be temporary, it can be a treasury decision. But when it happens during a volatility spike, it can create shockwaves. So what might force a company or institutions around it to move fast? Start with tariffs and the currency. If trade tension spikes, the Korean won can weaken. A weaker one can raise the cost of dollar-denominated inputs. It can also change the value of dollar debt. Then banks and counterparties start getting cautious. Collateral demands can rise. Hedge positions need adjustment. And if you're exposed in multiple markets, you don't always get to choose what you sell. You sell what you can. Now layer in the reality that big corporations don't just hold cash in a checking account. They manage cash in portfolios, short-term bonds, money markets, commercial paper. Sometimes hedges that are meant to smooth costs, sometimes structured positions that are designed to reduce risk, but can behave badly when volatility spikes. In calm times, these systems work quietly. In stress, they can turn into a chain reaction. Here's a simple example. Let's say a major player has a hedge tied to currencies and rates, and it moves against them fast. The bank says, post more collateral. They need dollars. They raise dollars by selling something liquid. Those sales pressure markets. Pressure makes volatility jump. Higher volatility increases collateral requirements again. Now the loop feeds itself, and during this loop, silver can get hit even if nobody hates silver, because silver sits at a crossroads. It is a commodity that trades like a financial asset. It gets included in risk baskets. It gets used in macro trades. It can be part of inflation hedges and growth hedges at the same time, and that makes it vulnerable when funds need to de-risk quickly. So when the tariff story heats up, what happens in the first minutes? You'll see the dollar catch a bid, especially if the market thinks global growth gets hit outside the US. You'll see Asian equities wobble. You'll see exporters get slapped. You'll see bond yields react. And you all see commodities start pricing in less demand, even while people are yelling, safe haven. This is where silver gets whipsawed. The safe haven crowd buys. The industrial demand is at risk crowd sells. Then the leveraged crowd gets forced out, and whichever side runs out of collateral first loses in a hurry. Now let's connect this back to the kind of intraday move you saw. A drop that fast often has three ingredients. First, a headline that changes the narrative. Tariffs do that instantly because they're policy risk. Second, thin liquidity at the wrong time of day. Asia hours can be thinner for certain US sun-centric products and vice versa, depending on what instrument you're watching. Third, a forced seller. Not someone trading a view, but someone meeting a requirement. So the question becomes, why would a forced seller show up at that exact moment? If the market believed South Korea was directly in tariff crosshairs, or if supply chains tied to Korean tech were suddenly at risk, institutions exposed to Korean assets might reduce risk quickly. That can mean selling Korean equities, selling related ETFs, and unwinding hedges. And when those hedges get unwound, it can involve selling dollars, selling commodities, buying rates, stuff that looks unrelated on the surface but is connected through the plumbing. Also, remember how modern finance works. Banks and funds don't manage risk one position at a time. They manage risk as a portfolio. If one area becomes toxic, they cut across the board to get their volatility down. It is like when your house catches fire and you don't need to waste time saving one chair. You grab what you can, you get out, and you deal with the mess later. Now imagine you're a risk manager and you see this combo: tariff uncertainty, Korea risk, semiconductor cycle anxiety, and a metal market that is suddenly gapping. What do? You reduce gross exposure. You cut leverage. You tell desks to lighten up. And that's where emergency liquidation becomes a real thing, not as a conspiracy, but as a risk response. And here's the plot twist that keeps this story interesting. A lot of retail traders think the big guys always know what's coming. Sometimes they do, sometimes they don't. But what they always know is their own risk limits. And when those limits get hit, they sell first and ask questions later. That's why these events feel like a trap. You'll see silver moving up, you'll see bullish posts everywhere, and then suddenly it's like a trap door opens. So what's the takeaway so far? Tariff headlines can shift growth expectations in minutes. That can hit industrial-linked assets like silver. South Korea, because of its role in global tech and exports, becomes sensitive to trade risk. And when a large corporate ecosystem needs liquidity or reduces risk, it can amplify moves across markets in ways that look random, unless you understand the plumbing. So where does this go from here? The market usually picks one of three paths after a violent 4-hour flush like this. Path 1 is the dead cat bounce. Price snaps back because the forced selling ends, shorts take profit, and bargain hunters step in. It feels like the crash is over, but it's really just the market catching its breath. Path 2 is consolidation. Price chops sideways, volatility stays elevated, and the market waits for confirmation. Actual policy detail, actual data, actual follow-through. This is the phase that burns people out because it feels boring, then suddenly spikes again. Path 3 is continuation. That happens when the headline becomes real policy, or when more forced selling appears, or when other markets confirm the risk-off move. Then the initial drop wasn't the event. It was the warning shot. Now, which path silver takes depends less on vibes and more on a few practical signals. 1. Does the dollar keep rising? When tariffs and trade stress push the dollar up, commodities priced in dollars often struggle, especially if the move is driven by risk-off and not by inflation expectations. 2. What happens in bond yields? If yields drop because growth fears rise, that can sometimes support precious metals, but silver is mixed because of the industrial link. You need to watch whether the market is pricing recession risk or inflation risk. Gold often loves pure fear. Silver is more complicated. 3. What happens in equities tied to global manufacturing, semiconductors, exporters, and Asian indices? If those stabilize, silver often stabilizes too. If they keep sliding, silver can stay under pressure. And 4, the most important in a moment like this. Do we see signs of ongoing forced selling? That shows up as ugly candles, big volume spikes, and rebounds that fail quickly. When rebounds fail, it tells you sellers are still using strength to get out. Now let's talk about the Trump tariff angle without getting lost in politics. Markets don't care about speeches as much as they care about probability. If traders believe tariffs are likely, they price it. If they think it's negotiation theater, they fade it. The problem is that you don't always know which one it is until later, and by then the fast money already moved. So instead of trying to mind read politicians, focus on what markets are saying in real time. If the tariff story is truly escalating, you'll usually see a coordinated reaction. Stronger dollar, weaker Asian exporters, pressure on industrial commodities, and more volatility. If it's mostly noise, you'll see the initial spike in volatility fade and markets start acting normal again. Now, about Samsung and the South Korea liquidation talk. Even if the dramatic wording online is exaggerated, the concept is real. When a massive corporate ecosystem shifts into defense mode, it can create selling pressure far beyond its own stock. It can influence suppliers, banks, local indexes, currency hedges, and any fund that's heavily exposed to that region or that theme. And here's a simple truth. When big money needs cash, it sells what it can, not what it wants. That is why you can see silver drop even if the long-term story for metals hasn't changed much. Short-term, the market is clearing leverage. Long-term, the market is pricing supply, demand, and purchasing power. Those are different games. So what should you do with this information? First, don't confuse a violent move with a permanent truth. A flush can be a liquidation event, not a new fair value. Sometimes the biggest drops happen at the worst time to panic because the panic itself is the fuel. Second, if you trade, respect volatility. When a market can swing that hard in hours, position size matters more than being right. Most people don't blow up because they were wrong. They blow up because they were oversized. Third, keep an eye on the next headline, but don't marry it. The real driver is whether policy becomes action. Watch for official statements, timelines, and any sign of retaliation. Tariffs are not a one-line story. They're a chain: announcement, negotiation, implementation, response. Now let me give you a storytelling way to remember what happened today. Think of the market as a crowded theater. Someone yells, "Fire," and everyone stands up at once. The exit is the same size it was 5 minutes ago, but now you've got a stampede. Prices don't move because value changed. Prices move because the exit got crowded. That's liquidity. That's why silver can fall fast, even when people are still bullish on silver. And here's the question I want to leave you with, because it matters for the next move. If tariffs keep escalating, do we get a real slowdown in global manufacturing? Or do we get a policy shock that turns into more money printing and more inflation fear later? Because those two outcomes can push silver in opposite directions at different times. First, down on growth fear and liquidation, later up on currency debasement and inflation hedging. The timing is the hard part, and the timing is where most people get trapped. So going forward, watch the plumbing markets as much as the headline markets. Watch the dollar, watch rates, watch credit stress signals, watch Asia open and Europe open reactions. If those calm down, silver often finds its feet. If those get worse, you can get another air pocket. And one more thing, be careful with anyone who tells you one person controls a global market with a single sentence. Headlines can trigger moves, yes, but the size of the move usually comes from positioning and leverage already sitting there like dry wood. The headline is the match. The leverage is the fuel. Now, I want to hear from you because it helps everyone watching. Do you think this silver dump was mostly a tariff-driven growth scare or mostly a forced liquidation event that just used tariffs as the excuse? Drop your take in the comments and tell me what you were watching in real time. Silver, the dollar, stocks, or something else. And if you know someone who's been confused by this move, share this video with them. It'll help them understand what's really going on behind the chart. And it helps the channel reach more people who want the real story instead of just noise.